Okay, afternoon all. I believe you can all hear me now, hopefully. Thank you for joining us, firstly. I hope you're well. So for those of you that don't know me, my name's Greg Edwards, and I'm here with my colleague, Sarah Jones, who you'll see just next to me. Now we're here today, so we have, just to give you a little bit of background as to who we are and what we're doing here today. So we both work for a company called Thomas Carroll Insurance Brokers, who over the last, I've certainly been or known Puma for maybe up to 2 years now. It kind of started as a kind of informal arrangement whereby I knew a couple of the guys in the team, and we just helped out with arranging some work for some of your borrowers. And then over the last 6 months, through Charlie and some of the legal team, we've actually been appointed to provide an audit service for you, and that's going well at the moment. It's ongoing, and as part of that process, we thought it'd be a good idea to do some training to hopefully help demystify some of the things you come across. So as you can see below, that's myself and Sarah. That's pre-lockdown, so yeah, I'm probably a few pounds lighter there, and it is a little better. But yeah, let's move on. Next slide, so we can just go through the format for you. Okay, there we go. So the purpose of today is to provide you with an overview of some of the insurances you'll come across, and hope that you can then recognize some key features, and it'd be a little bit easier for you really to understand some of the lingo and some of the different things that are in some of the policies you come across. So the structure today, I'll wrap up in a moment. I'm just going to talk a little bit about Thomas Carroll on the next slide, and then we'll get into the I'll talk about construction and real estate for roughly 25 minutes. Hand over to Sarah, who's going to talk about legal indemnities as the head of our department there, and then we'll do some questions at the end. So the way this is going to work, I think you've worked out by now that we can't hear or see you, which is a little strange. But what you can do is on the taskbar on the right, you've got a little questions box, which if you've got any questions or you want us to expand on anything we talk about, I'd encourage you just to write anything in there. What we'll do is when we wrap up towards the end, we'll have 5 or 10 minutes where Sarah and I'll answer those questions. And go through anything further you want to know. I suppose if you've got kind of specific questions on projects you're dealing with, we're going to distribute our details after this and follow up with a copy of the slides. So we're happy to answer those separately following this. Right, next slide. Okay, so a little bit about Thomas Carroll. So we were established in 1972, so we're coming up to 50 years old. We started as a kind of a family company, a small kind of family company. The good thing about the businesses are, so that the Thomas and Thomas Carroll, a gentleman called Evan Thomas started the business, and our CEO, Rhys Thomas, is actually Evan's son. So whilst we've grown to be much bigger than we were back then, we still retain a kind of family sort of personal approach that we've always had. 150 of us in the group altogether, split over 6 UK offices. Sarah and I work predominantly out of our London office, which is where our real estate and construction specialism is. We can, as a brokerage on a whole, we deal with all manner of clients, but our main specialism in London is real estate and construction. We're chartered across all of our businesses, which bizarrely in the insurance industry, there's no minimum qualification to be able to give advice. So we pride ourselves on trying to be a market leader and ensuring that all of our people are as qualified as they can be. So we've got a high percentage R, which means that we've achieved charter status across the whole business. 4 business streams. So we sit in the commercial broking department, Sarah and I, and then we've also got a personal high net worth department, health and safety, and then life, health, and pensions. Just like we've won some awards as well. We were 2018 Broker of the Year and Commercial Lines Broker of the Year. It hasn't gone downhill since 2018, but we just don't apply every year. It's quite a big process to go through. So yeah, rest assured that we're still performing as we were then. And then finally, really quick before we get into the content, we're part of the UNA Alliance. So it's an alliance of the UK's largest independent brokers. And what we do there really is brokers up and down the country. I think there's 13 of us in the alliance. We get better terms from insurers. We lobby them on key issues in the insurance marketplace. I get preferential terms, schemes, and I just get a kind of better voice at the boardroom table with a number of the key insurers. So let's get into the content. So to start, we'll start with construction. So construction is probably one of the most difficult. I say difficult. It's one of the most complex areas in terms of insuring assets or material damage. Purely because if you're insuring a property or insuring a home or insuring a car or a piece of plant or equipment, you can point at it and say that's exactly what it is. Whereas with construction insurances, you're basing it on the start of a project where nothing's happened and covering all the way up until practically completion. At any one time, you're at various different stages. So to keep it really basic, just to give you a really simple understanding, a lot of you may know this already, but if you're, for example, if you are just building a wall, so if it's 10 across, 10 high, you're basically covering it from the first brick you put in all the way till the final brick as to when it's signed off. If when you're 5 rows high and 5 rows up, a car drives into it and bashes through it, then the insurer is gonna pay for you to rebuild that wall up to where it was, so 5 across and 5 high. So the idea is not to better or to finish the project for you, but to indemnify you and put you in the position that you were prior to the loss. So the second point there, moving on to the type of kind of construction work that you deal with. So on any one project, this is probably the most crucial thing. So if you forget most of what we talked about today, I would urge you to remember this. It's quite basic, but it's often missed and something we come across all the time, and it ends up being a last-minute scramble then for us to do this. So the insurances for a project must follow the contractual obligations, which seems really simple, but so whether it's a JCT contract, it normally would be, or NEC or another type of building contract, whatever is said in there, usually in clause, there's usually section 6 where the insurance clauses are, breaks down exactly who is responsible for the insurances. So usually, I mean, most of your contracts I would think would be under either an intermediate or a standard JCT. I think intermediate's 500,000, then standard's $1 million plus. There's 3 options. So options A, B, and C. I think you likely would have come across these in the past. But options A and B are for where it's a new build, and then option C is for where there's an existing structure, so like a refurb or a renovation. So for options A and B, option A is where it's contractor-led, and a contractor will take out the policy in joint names to cover the works from start to PT. Option B is employer-led, but the same thing, that they're covering the contract works from the start until PT. And then option C involves an existing structure, and the employer will set up a policy that they lead for the works and for the existing structure, so on an all risks basis. So the key point here really is that where there's often kind of a last minute debate and is scrabbling around to get terms, is where there's a bit of a misunderstanding. So what tends to happen is, because developers will go out to a contractor and say, okay, this contract may cost 1 million, 2 million, 5 million. By virtue of the fact they're asking a contractor to do the work, they a lot assume that the contractor is also responsible for insuring the works, which is correct in some ways. The contractor will have an existing policy, but it totally comes down to the contract and what's been agreed in the various the options. The key thing is, if there's an existing structure and it's a refurb or a renovation, it should always be option C. So it should always be employer-led for the work and the existing structure. Because if it isn't, it just becomes a real mess and a real difficulty, because you've got, if it's, say for example, the developer's covering the existing building and the contractor's covering the works, if there's a claim during the period of build in the refurb or renovation, you'll have 2 different insurers trying to debate which is classed as the works, which is classed as the existing structure, and it just becomes really, really difficult, and it's just going to slow everything down. There's not a clear like demarcation between this is the existing structure and this is the works. So legally, it should always be option C, employer-led. But we found many times that the developers come to us and said, can you just insure this existing structure for us? It's under renovation. The contractor's looking after the works, and then it quickly transpires late in the day as they're closing or drawing down on funding. But actually, it should be option C, because that's what's been selected in the JCT contract. And just to add to that, the contract conditions clause is common in a policy wording for a construction for a construction policy, which basically says that the insurer, that there's no cover under the contract works policy if another party is responsible in the build contract for arranging cover. So it's basically adding to what I said earlier, is that it all comes back to the contract. So whereas if for example, it says you've got a contractor's policy that you're looking after, if the contract actually says it should be option C, which means the employer should arrange it, then effectively the contractor's work is being excluded because the responsibility is actually on the employer. So I would just, my advice to you is it's always to make certain that I imagine you get copies of the building contract, but that literally is, it tells you exactly who to insure. So it's relatively simple, but it depends on the people filling it out. I'll talk about 651 cover later, non-exigent liability, and you'll be amazed how many times that is ticked in a T contract by either party, but nobody really understands why, or it's just been selected because it's a mistake and they think they're actually selecting public liability. The final thing to say then is just on a general term, I'll go into the two types of the annual contractors and the kind of project specific later. But the whole point of construction insurance is written on an all risks basis, so it's designed to be as flexible as possible, because any contractor will do might do, you know, they might have 12, 15 multiple sites at any one time. So the whole point is everything's on kind of an all risks basis, so any plant is covered within the territorial limits, which is generally UK, at any site at any one time. So it's designed to be as broad as it can be. So moving on then to, so there's two real types I think you'll come across, and it's going to be option A, this will be, or option B and C. So option A is generally where you're relying on an annual contractor's policy. So this is basically a single policy that covers the contractor for all works up to a maximum contract value and to a maximum contract period. Likely you'll come across 10 million, maybe more, depending on this. It very much depends on the size of the contractor. So if the bulk of their work is under 500,000, then you'd expect that the limit might be that, or the maximum contract value might be that, and then they may need to increase it if they take on something above that. But it's all based on how much work they do within the 12 months and the maximum contract value. The important thing to say is that any contract is covered up to that 10 million. If it's 10 million and £1, it's not covered. So it's absolutely critical that that is made clear. There is a clause in the policy wording for variation. So if during the build it starts at 10 million and then changes and it may go up to 11 million or 12 million, there's usually what's called an escalation clause in the policy wording that provides like a 25% buffer, so that if there are variations, they're kind of automatically covered. But usually the broker will be as informed as they can be, and you'd like to think the client will tell them if there are variations. Usually in an annual contractor's policy, they're called a couple of different things you might come across. CAR is one, CAR car, as some people, car insurance, as some people refer to it. Contractors combined is another way to describe it. So there's quite a few different things, and it's always the same in the insurance industry. There's a range of acronyms, different things for the same thing. But ultimately, it's deciding whether it's an annual policy or contract specific. That's the real two differences for me. So then within the combined policy, then you'll have a range of other risks. So it won't just be just for contracts. It'll be things like own plant, hired-in plants, temporary buildings like porta cabins and the like that the contractor is likely to use. Public liability, obviously, be a big part of it. There may well be a top-up policy, so you'll have a public liability limit of say 5 or 10 million within the underlying construction policy, and then that may well be topped up by an excess, but it generally depends on the work the contractor's doing. Employer's liability, again, covering all their staff on site. Terrorism cover, some contractors buy it within the annual policy because they take the view that most employers will want it on every single case or on every single contract they work on. But it very much depends. It's not necessary. I mean, if they're doing a lot of contracts within central London, you think they probably would have it. But if they're doing a lot of work kind of outside and in like more rural areas, probably a bit rarer. And generally, it's lender-led. So if they do a lot of work that's being funded, or they're working with a lot of employers that are likely to have funding with lenders that require terrorism, you may well find that they're asked so much for it, they just include it within their annual cover. 651, I'll talk about that specifically later on, but you can, the general guide is that you'd extend, if 651 is required, the contractor would extend the contractual CAR policy to include 651 as an extension to the public liability, because if there were a 651 scenario, it would always be, it's a case of not there being no negligence on behalf of the contractor. So it makes sense for them to extend that policy, because it's going to be one of the two. It'll either be them being negligent or not negligent, in which case it'll be 651. But I'll talk about that later because it's quite a complex area. Common conditions and restrictions, you'll come across these when you're on your due diligence work, no doubt. Fire precaution condition, that's fairly standard. The key thing there is just that if is that the contractor's aware of it, which they will be if it's in the annual policy, but just that they're following it to the letter. The joint code of practice, this is something by the Fire Protection Association, and insurers are involved in as well. It's essentially contracts, usually with a contract value over 2.5 million. Most insurance policies will say that the joint code of practice applies and it must be adhered to. There's actually a tick box in the JCT contract as well to confirm whether the employer and contractor are following the code of practice. And what the insurers reserve the right to do is to turn up at the site and check that it's being adhered to. So yeah, the contractor just has to be aware that this is in play, and it needs to be. I mean, most contractors who are doing work of any size will be aware of it and know they need to adhere to it. Timber construction is obviously difficult in terms of combustibility. If there's a maximum contract value of say 10 million or 5 million, you'd probably expect to see an inner limit for timber construction, which may be 1-2 million, depending on the insurer, purely because insurers don't really want to take on risks that have a high element of timber in the construction unless they know the full details and the combustibility of the timber. So yeah, just something to be aware of, because it's usually within an endorsement or sometimes hidden in the policy wording. So it is worth, the policy wording is never exciting to read, but that 140-page document does tell you exactly what's excluded and included. Hazardous locations, again, fairly straightforward. Things like ports, bridges, docks, trackside, railside, anything in an airport or near an airport would usually be excluded unless the contractor has kind of declared it within the kind of work they tend to do. If they're doing it all the time, then it would probably be written into the policy. But yeah, if I suppose if you get any developments that come across that are in kind of unusual areas, I would just check that it's usually in the policy word in the hazardous locations condition doesn't exclude work at those locations. And then finally, depth and height. Not all policies have it in, but sometimes in the policy wording you've got a depth limit or height limit of usually 10 meters. So if there's any work being done at any particular height over that or under that into the ground, then be aware that it may be excluded generally in the policy wording. But I said, if the contractor is doing this work regularly, it's likely that it'll be in there anyway. Okay. Moving on, so this is the second type then. So we've talked about the contractor's annual policy, which is usually option A, where the contractor is responsible for the insurance. So under the other two, you generally have what's called there's a couple of names. So there's two things. There's a contract works policy, which is employer-led, which is basically a single policy that's specific to the individual development. And that would be taken out by the employer, and that would cover the contract works from start to PC just for that specific project. You may also see a term called OSIP and CSIP. Insurers love an acronym, but these are simply OSIP and CSIP are probably a little bit bigger than a single project contract works policy, in that they're more designed to be kind of collaborative and based on bigger, larger, more complex projects. And what they can do is, whereas a single project contract works policy will just cover the works and it'll cover contingent liability for the employer, what an OSIP and a CSIP will do is say, actually, this is a collaborative project, we're going to cover everyone here because the goal is to deliver on time, good quality, and actually the risk here is large. If there was a delay for whatever reason or a fire, then it's absolutely critical that we get this back on the road because of all the different various interests involved. So what the employer may do then through an OTIP is say, right, we're going to cover the liability for all parties. So whereas it would just usually be covering the employer's contingent liability in case an action was brought against them for owning the site, it'll actually say we're covering the funder, we're covering ourselves, we're covering all contractors, or the principal contractor, and then all tier subcontractors under one single policy. So it's a bit of a catch-all. It's effectively saying we're covering everyone. And the reason for that is generally, they go on the second point there, it's flexible, built specifically for an individual purpose, and usually where it's a larger project where it's very collaborative. The difficult thing with an OTIP is cost generally. So it's very much based on the employer saying to the contractor, look, we're going to take on the insurance arrangements here. We're going to fit the bill for it, but we'd like you to reduce your contract price to reflect that. So there's a bit of kind of negotiation between the two parties, whereas I would say on smaller projects, sometimes the developer's happy for the contractor just to include a little insurance price within the contract value and let them take the insurance risk because they don't want the hassle of arranging it. Whereas with this, it's a bit more of a, let's collaborate on this. It's a big old project, so we'd actually like the control over it. And to be honest, when we advise our clients, it's the employer's revenue stream. So generally, we'd like to see the employer take out the insurances, because if you're leaving it to the contractor, if the contractor goes bust or there's an issue with payments to the subcontractors, or there's an argument on site for whatever reason and it needs to be accounted in the contract, you've got to reset up a whole new policy. Whereas if there's an OSIP or a employer-led program there, then it's as simple as replacing the contractor and notifying the insurer there's a different contractor. So we would always advise it to be employer-led, purely because it's their revenue stream and that they're protecting. Just third point then, design with collaboration in mind. I've already covered that really. And then the final point, that OTIP and CTIP can cover liability for all parties. So that the parties insured will be lender, all contractors or principal contractor, and all subcontractors, and the employer. So next slide. So I'll give you a quick example of one that we worked on just prior to end of 2019. So there was a large and occupied grade 2 listed existing structure, £5 million plus, city centre location and immediately adjacent to the railway network going into the city centre on a main line going out to somewhere else. So I don't know if you come across this, but any works that are near or immediately adjacent to a network rail infrastructure, they often ask for an asset protection agreement, which within that agreement, it generally requests a limit of 155 million for public liability, which is an extortionate amount, and you won't generally come up against a limit like that unless it's a kind of national company that are doing really heavy infrastructure works. So it makes sense to set up an OTIP because you can cover all the subcontractors in a single policy that goes up to 155 million. Because we're the best will in the world, you're never going to get a small subcontractor who might only be doing like mechanical and electrical work with a small contract value to get a limit of 155 million. It just isn't going to happen. So under a single policy, you can cover them, and it's covering all tier subcontractors up to the 155 million. On this one, there was part demolition as well. So the existing grade 2 listed structure was being retained, but the rest of it being demolished. And it was time critical because it had to be done at a time where there wasn't the normal level of service into the railway station. So that was kind of like a 2-3 day period where it needed to be done. So again, it was kind of quite high risk, and the OSIP made sense because it was clear that all parties were covered for this work, with the idea that if there were any delays or any issues that due to insured damage, that there was no arguing between parties that who was liable. It's just a case of there's a single policy for recourse that would just pay, and they could crack on with remedying what had happened. On this particular one as well, it was a large 651 risk. Again, I'll come on to 651 later in a little bit more detail, but basically they were doing heavy piling works into the foundations, and it was a host of neighbouring buildings with like national companies. That meant that the risk was quite high. So if they're digging into the ground and there was any kind of vibration or or damage to a neighbouring building as a result of the groundworks, yeah, the risk was quite high, so there needed to be quite a comprehensive limit for 651 in case anything did happen. And then the final point then, that there was forward funding by large investment firm, and then the long-term operator was secured. So quite a lot of people involved in this particular development, which meant that the OTIP just made sense because of the size, the hazardous nature, and the fact that there was kind of already pre-agreed what was going to happen throughout the whole process. So it just made sense that there was a single policy. There was no arguing then if there was an issue between, is it the contractors' insurers, is it the employers, is it the subcontractors? It was just a single policy covering everyone. So everything's covered by the one policy. Okay, let's move on to 651. So 651, it's funny. So this started in this case in 1958. Gold was the employer, and he'd employed a contractor to do some piling work within the property. Neighbouring building got damaged, and immediately Gold tried to point to the contractor and say, actually, this is a result of the work that you're doing. And it was actually held that the contractor wasn't negligent in any way, but that Gold still owed a duty to the neighbouring party by virtue of the fact that the property had been damaged. So it's a non-negligent risk. So the contractor is negligent, the employer, by virtue of owning the property, is responsible for the damage to the neighbouring building. I mean, if I'm being completely honest, we don't see a huge amount of claims because 99.9% of any damage would be caused by contractor negligence, you would think. It's just where there may be heavy works being done, and they're being done in a correct manner, just by virtue of the fact that the work's happening. There's maybe vibration or underground movement that causes damage to a neighbouring building. So it is important to make sure there is cover in place. Now, the cover 651 is actually the clause within the JCT contract. So whether you can literally look back at the contract, like I said at the start, and see whether it is covered. What often happens is sometimes it's ticked because it's believed that it's actually public liability, and the employer will tick and say, yeah, okay, we want the contractor to have public liability cover, and not actually realise that it's 651, because that's the clause number anyway in the contract. So the employer requests it through the JCT contract. There's usually a limit assigned to it, whether it's 5 or 10 million. The contractor will arrange it, and then the employer pays for the contract. So it's not covering the contractor in any way. It's covering the risk to the employer of damage that's non-negligent, so no negligence on the contractor. They've done everything they can, just by virtue of the fact of them being there doing the work. The neighbouring building's been damaged. I would only say, if you're advising a developer or employer, or it comes up in conversation, or maybe if you're requesting it as part of the finance, that it's only really a consideration when there's heavier works like piling, underpinning, or heavy vibrational works, and there's neighbouring buildings. What we often find is sometimes 651's being requested through the JCT contract. There's not much of an understanding as to why, and then when we actually get into the discussion as to why, quickly nobody really knows what it's covering. It was just ticked because they thought, yeah, we'll include as much as we can. So yeah, it often need to go back to the root of what's actually being done and understand whether it is actually a risk, rather than just an assumption that, yeah, we'll include it because we're kind of going belt and braces. I think equally as complicated, delay in startup, advance, loss of profits. So this, I think, it is a consideration for some clients, the right clients, and for the right project. I think we'll often sometimes delay in startup is seen as like a golden ticket to protecting the revenue stream if there is damage. It can be in some ways. We've got to remember that the insurance is only designed to put you back in a place you were prior to damage. It's not going to benefit you in any way over and above putting you back in a place you were before. So usually you see delay in startup cover on a development that's maybe time critical, or a larger project where there's a real concern that if there's damage, insured damage within the life cycle of the project, that the project isn't going to deliver on time. Now, I know every project needs to deliver on time generally, but specifically it might be, say for what we tend to cover against is student developments. So if there needs to complete in August ahead of the September, if they miss the September deadline, then they won't have they won't meet the first term or the that academic year, which may be the guarantee that the university will kind of put them within with their allocated amount of student beds, for example, which means that they have to pick up the next academic year, which is obviously a real risk then. And then the other side then, I suppose, is for funders. So some of you guys, that if it isn't delivered on time, there's obviously debt servicing and increased interest costs which need to be met. Which if the revenues aren't there for the developer and they haven't got a particularly strong cash flow, then they may go out of business by the time the building is actually rebuilt or the works are actually finished. So the key thing to remember is it's contingent on insured damage. So it has to be insured damage. That's the driver. So anything other than insured damage, the DSU won't kick in. That's the trigger, if you like. The construction schedule is critical. So what will happen is if there is a loss, there's insured damage, the DSU or delay in startup is triggered. And then what will happen then is the loss adjuster comes out and works out exactly where the construction schedule was prior to the loss. And then there's a complex calculation worked out then as to what costs would be incurred as a result of the damage happening. It is quite, I mean, if you've got any specific questions on DSU and how it may be used on a specific project, I'd say to ask, because each project's different. There may be different costs that are included in that. It generally covers debt servicing and net profit, but it does depend on the type of things that would be, there would be affected by there being insured damage. Like I say, it's quite complex. If you look at how the claims are adjusted, it's quite difficult and complex, like I said. So if you've got any questions on a specific contract and think DSU should be a consideration, then then drop me an email or we can have a conversation. I can tell you whether realistically it would benefit in that kind of scenario. Okay, I think I've got an example. So this is actually one which is actually a Puma case that you funded, one I worked on with Paul O'Kane, which I don't think he's on this call at the moment, but one where we managed to actually use DSU to benefit and to get the funding over the line. So it was an airspace development where there was development above an existing freehold. The freehold was owned by another party, the airspace development by the developer. And the key concern was that if the existing structure, which wasn't owned by the developer client, were to burn down or become damaged, then the airspace that the developer was building on would actually have next to no value until the existing building was rebuilt. So what the big concern then was that there may be like a 2 or 3 year period where they were waiting for the existing structure to be rebuilt. There's no control over that either because it's a different insurer, which would mean that the debt costs then would spiral and ultimately there'd just be a long wait with no revenue being generated until the existing structure was rebuilt. So DSU worked because what it allowed was a mechanism to secure revenue then to service the debt and realize the profit that the client would have benefited from had an incident not occurred. So in the scenario, the lender was happy to lend, or you were happy to lend, based on the fact that you knew the client's debt servicing costs and potential profit out of the project were protected in the event of that existing structure being damaged. So yeah, like I said, if you've got issues on DSU and advanced loss of profits, just on a specific project, let me know, because it is a complex area and it isn't a solution to everything. There's quite crucial rules and other ways it needs to be looked at properly. Lender clauses, okay, a topic of much debate for us. A fair few. So co-insured is probably seems to be the standard at the moment and what most lenders require, or certainly most lenders that are taking it seriously. I mean, there's some lenders out there that just request a note of interest, which doesn't have any practical legal effect, and is obviously simply added by an insurer, but doesn't really give any protection to the lender other than an acknowledgement that they exist. That's effectively where we are. So comms insured is, you'll likely know this, is a separate legal contract, which is a part of, so obviously the client's got a contract with the insurer. If the lender is added as co-insured, they've got a separate legal contract with the insurer. So it means effectively that the insurer can't rely on the policy terms. If there's a condition in there that says, for example, the client must do X, Y, Z, it doesn't matter if the client contravenes that, because there's a separate legal contract with the funder. Now, the thing to say is that while it's a separate legal contract with the funder benefits from the policy, but also has obligations under it. So things like paying the premium, duty of disclosure, the lender would usually carve these out. I know you guys do usually within your due diligence work, is because simply you wouldn't be close enough to the development or close enough to the client to actually have any duty of disclosure or know individual circumstances. So yeah, it's important that those things go along with the co-insured. In terms of agreeing co-insured in the market, I mean, most of the main insurers, you kind of like Zurich, AXA, Allianz, Aviva, would have quite a good understanding of what this is, why it's being added. Some will charge, we're seeing more so now, that anywhere from 10 to 15% of premium to add these things on, which is difficult to justify to a client sometimes, particularly because it's driven by the lender and it's a cost that the client will have to pay. But insurers are kind of clamping down and realizing that it is a bit more of an exposure for them. That's for the brokers and the client to negotiate. Moving on then, first loss pay, which again is fairly standard and will be added. There's not really much resistance for insurers to add this. The only thing I will say is that usually they'd want a limit, so in excess of 50,000 might be a good starting point, purely because what they're doing is agreeing to pay the bank first. First loss pay is pretty self-explanatory, but the excess of over the 50k makes sense, because smaller claims, for example, if there's like a small water loss or any small loss, you have to pay the bank then, and it just delays the whole point of the contract for it to be a reinstatement or replacement. So paying the lender in the first instance for smaller things delays the whole process, and it's not really in the client's best interests. So yeah, we'd usually expect there to be a 50k limit, which means that then you're only really interested in bigger payments. Again, important to mention that insurers are key, that the policy is with the client, it's a policy reinstatement, so the money should always be used to reinstate, repair the existing, whether it's works or whether it's a building, because otherwise it shouldn't be used to pay down the loan, because that's not the basis of the original contract. Note of interest, I've already discussed that. It's got no practical legal effect other than to acknowledge the lender exists. So I wouldn't, yeah, we do see them often if it's kind of smaller funders or smaller banks that aren't really set up to understand why the interests need to be protected. Yeah, not something we see regularly now. It's mostly kind of co-insured, first loss pay, and then non-invalidation and non-vitiation. So there's various different wordings that different lenders apply here. Insurers, I don't know, some are okay and some aren't, depends on the wording. The difficult thing is that what you're basically asking the insurer to do is that if the borrower or the contractor or whoever the policyholder is contravenes the condition, the policy still operates for the other parties. So it can be difficult. It depends on the conditions. There's various different wordings, but I would just say insurers don't generally like them, but it depends on the crucial thing with all of these lender clauses is generally the understanding of the different parties, and we found this through the cases we've dealt with you. If the borrower's broker isn't au fait with them, or if someone at the insurer isn't au fait with them, then it just adds to the process, the delay, and yeah, just makes it a real issue, to be honest. So it's key that all parties agree, and I mean, most of the key insurers would be geared up to insure and to add these in. Okay, okay, so that's construction. It's a bit of a whistle-stop tour this, so I imagine you could talk for hours about different nuances. If you have got any specific questions, then please ask away, or I can follow up and have a separate discussion with you. But I'll move on now to real estate and property. I'm not going to go through what it's covering, because I think it's abundantly clear that we're covering a structure with a defined value. But I've just picked up some few things to be concerned about in the market at the moment. So perils is one thing which you will come across. There's two ways of insurance policy operating. So generally there's all risks, which is basically saying you're covered for everything unless it's excluded in the policy. or you've got specified perils where it'll say you are covered for fire, theft, malicious damage, and actually specify those within the policy. What I would say is that there's being what's happening at the moment is insurers are tending to look to restrict perils specifically on, I'm going to come on to, on occupied property and properties under construction. Well, what insurers do is as soon as they get a risk, they've usually got a postcode checker. So we'll go into their system to say, right, this postcode they'll have a rating system. So for flood, it may be 1 to 5, 5 being the worst, 1 being the best. For theft, for arson, for subsidence, for all these various different things. And if one of them flags as being, say, a 4 or 5, they'll likely want a higher excess or restrict the peril or exclude the cover altogether. And that's happening more so. It probably move on to point 3, flood and escape of water. I mean, if a risk is in a poor flood area, according to insurer systems, like a 4 or 5, for example, it's likely they're either going to want to exclude it altogether or have an incredibly high excess, or a co-insurance clause where basically the client will pay like say 40 or 50% of any claim out of their own pocket. The insurer is only responsible for a percentage of claim. So it's almost like a co-insurance basically, where both parties are responsible. So it's less cover. Layering, again, it's quite complex, but it's basically if you've got a £10 million building, what we're seeing more so now is insurers don't want to take the whole of the 10 million or the whole of the 20 million or 25, whatever it may be. They want to actually say, right, we'll take 10 and we'd like another insurer to take the other 10. So when you come across policies now, you expect more so, I think, where the market is at the moment, that you will get multiple insurers insuring up to a certain amount, purely because they want to limit their capacity on any one risk and don't want to take on the exposure they may have been happy with sort of 2 years ago when the market was in a bit better place. Again, layering I can go through with you in more detail, but if you've got specific contracts where layering has come in and you've got various different insurers taking a different percentage, but I'm happy to help with with letting you know how that operates. Flood, escape of water, just really quickly, 24% rise insurers reckon on escape of water claims, particularly in construction. It's a real risk from at the moment, and we're seeing that more so in construction and development sites. Water management is key, and insurers want to know kind of realms of detail on how that's being handled on site. Cladding, the Grenfell inquiry is on the go at the moment. The key thing here is what is the infill made of? Insurers will want to know chapter and verse on the cladding that's being used. And if you have any developments that you're lending on that have cladding or will have cladding, I would make sure that you've got all the details there and that we know exactly who's providing the cladding, what's the infill material is, and yeah, what it's made of effectively. I've covered unoccupied and under construction. What we see is restricted peril. So I had a question from one of you guys a few weeks ago. Flea cover, so fire, lightning, explosion, aircraft is the standard perils for an occupied property. That isn't full cover. That's basically covering you for fire. I mean, lightning, explosion, aircraft are rare. That's going to happen. But that's just where the market is at the moment. You're unlikely to get anything more than that for those. So just for you to be aware that our restricted cover is in place in the market at the moment. And finally, really quickly, I've gone on probably a little bit too long. Sorry, Sarah. I will wrap up in a minute. The harder market, we're in a difficult place at the moment. Insurers' investments aren't performing where they should be. We're in a great period of uncertainty. The volume of claims for COVID has been extortionate, although a number weren't actually covered, which is still an ongoing debate with this FTI test case. But basically where we are is that rates are going up, capacity is narrowing, policy conditions are increasing. So you're likely to see, whereas you may have seen less conditions and more kind of wider cover, be aware that you're likely to see kind of different conditions, different restrictions being placed on clients because the cover isn't there. I know certainly on professional indemnity, probably not real estate and construction, a type risk, but professional indemnity market's in a real difficult place. So we're certainly seeing aggregate limits, lower limits, many excess layers because insurers just don't want to take on the capacity. Okay, sorry, come up for air. Thank you. That's me for now. If you've got any questions on any of that, I appreciate it was a bit of a whistle-stop talk, but send me an email after or pick up the phone. I'll give you our details after this. But yeah, happy to answer any questions after. And over to you, Sarah.
Thanks, Greg. Hi everybody, I'm Sarah Jones. As Greg said, I head up the legal indemnities team at Thomas Carroll. Been here for coming up to 5 years now, and prior to that I came from a legal background, worked at a law firm in conveyancing and property for a number of years, so it helps to obviously have that background to merge with the insurance. Conscious that some of you, obviously, if not all of you, are probably aware of legal indemnities and some of the products that fall within that. So I've tried to select a few to talk about today that will be particularly relevant. But as Greg said, we can pick anything up afterwards, any questions, happy to answer those later on. So what are they? I completely appreciate that there can be a perception around legal indemnities that it's money for old rope. So I'm going to try and put a bit of context to this by using some case studies and examples later on. But ultimately, they're an insurance product providing financial protection where a defect in title threatens to abort a real estate transaction. Generally, most of these can be resolved legally. However, this can become expensive, long and protracted negotiations. And by doing so, this can preclude the proposer from then having an insurance option. So it really is an either-or situation. I'm often asked how quickly these can be arranged. Depending on the urgency and complexity of the risk, we can turn things around on the same day if we have enough notice. More generally, we're looking at a couple of days, and risks like rights to light may take a little longer, just given the amount of due diligence that underwriters will need to go through in order to offer terms. We have around 10 insurers on our panel, so it is a very small market when compared to the general commercial insurance realms. And with rights to light risks, that pool gets smaller again. So it is important to engage with a broker who's got good relationships with these insurers and who have direct access to senior underwriters within them and the decision makers ultimately, to make sure that you're getting those responses as quickly as possible. So how do they work? They are non-renewable policies, so it is a one-off premium. However, we can endorse policies if limits change or the insured use changes or any additional risks need adding. So that isn't a problem. They last in perpetuity, so they last forever, save for there are a small number of risks such as judicial review, build or indemnities and environmental risks. These may be limited to sort of 25, 35 years, and the reason being, these are risks that don't get better over time, so there's more chance of a claim in future. Whereas for things like restrictive covenants and access issues, the longer these go unchallenged, the better position insurers are in. Cover can be, it covers successes in title as well, so it'll cover the owners, successes in title, lenders, tenants, anyone else that you need included. These can be amended to reflect the specific needs of the scenario as well. And cover can be arranged on a pre or a post planning basis. One thing we've seen an increasing need for or asked for is two-stage policies. So this is where insurers essentially provide abortive planning cover for the first stage in the event planning permission isn't obtained, and we can then upgrade to stage 2 cover for the full limit of indemnity once we've got planning. So, you know, where this is good is it helps clients to avoid paying large insurance premiums. If the development is dependent on getting planning, then obviously, you know, they can sort of separate how much they pay at different stages. We also offer title wrappers, or as we call them, title wrappers. This is where we include a multitude of risks on a blanket basis in one go. Where we tend to use these is perhaps where there's limited time or limited due diligence has been completed, or perhaps on a portfolio basis, only a sample of due diligence, say 10% of properties due diligence has been completed on. And so these policies will then mop up any risks that perhaps haven't been identified within that process. These can be offered on a lender-only basis as well as full cover. And we can build in additional covers like liability to pay rent for tenants, etc. And the good thing about these as well is they can be splintered. So even though we can arrange them on a portfolio basis or for multiple sites, if those sites are then sold off separately, we can splinter that policy and it'll be a nominal sort of administration fee at that stage then to pass on to any future buyers. I've put on this slide, it sort of goes without saying, so apologies for that, but at no point obviously should any third parties be made aware of the existence of a policy, save for bona fide purchasers and their legal advisors, of course. Otherwise, obviously this will void the cover. And likewise, the insured should not engage in any correspondence relating to any of the insured risks that we cover in with anyone who they think may have the benefit. So I've put this slide up here just to give you a bit of a view really on the markets that we use. As I said, it is small. It's a niche area of insurance. Some of these names will be familiar to you, the likes of Zurich, Aviva, etc. And as I say, we've got direct access into the decision makers within these in order to get you the responses that you need as quickly as possible. So I'm going to go on to talk about a couple of specific risks now, mines and minerals being the first. I just want to say firstly, this list is by no means exhaustive. There are around 50 different types of legal indemnity risks that we can deal with. But as I say, I just picked up ones that you may be more familiar with or that may be more relevant to you and your clients. So mines and minerals then, cover is provided for the risks associated with carrying out development of a site where it may be affected by mines and minerals risks. It's important to note that the minerals underneath a property may be owned by a third party who can then enforce their rights to extract those minerals or seek damages against you for trespass caused by the construction. From a development perspective, cover is crucial really. It could be that you've got a fully developed housing development on a site which is subject to these rights. So although the reality is planning would be required for any mining activity, and if we've got a built out residential housing estate, it's unlikely the local authority will then grant planning for mining activity. But that doesn't prevent the risk of a claim being brought for trespass into those rights. So cover is quite important for both those elements. And again, important to have a broker involved to make sure that is the case, as some covers can look like trespass is covered, but it may not necessarily be the case. Multitude of factors that insurers will look at here. They will look to see if there are any registered owners of these rights. They may be unknown. Cover is available on both sides. Has there been any active litigation or objections at planning? And is there known mining in the area, or is there the prospect of mining in the future? Various things like that. But chances are, if we're talking about an already built up area, insurers are going to get pretty comfortable with these risks pretty quickly. So it's very rare that we're unable to structure cover for this type of risk. Moving on to restrictive covenants then. So a restrictive covenant will create a restriction on title to the property that's intended to prevent a buyer from using or developing the land in a certain way. It continues to bind successors in title, so it is applicable to the land itself generally. And it may be that the benefit belongs to a defined group of people or to owners of benefiting land, and where issues arise is where lawyers may not be able to identify or clearly identify that benefiting land or indeed the beneficiaries. And so you're looking at a complete unknown which needs to be covered off from an insurance perspective. For developers, in order to facilitate sort of quick and easy plot sales, if they're building multiple dwellings on the site subject to restrictive covenants, they may not want to have to deal with that issue on an individual basis with each of the solicitors for each plot purchaser. So we can arrange a single policy covering the entire development, which represents the most efficient and cost effective solution for the developer generally. And then again, we can splinter those for individual plot purchases. So you'll just have one covering the site, and then as those are sold off, we can splinter those off as well. Again, cover can be available on a pre and post planning basis, dependent on the situation, the particular. It depends on the geographical location. There's a number of things that will be taken into account that I will mention a little bit later on as well. The next one to talk about, judicial review. So this is one of those covers that isn't offered in perpetuity because it is obviously a time limited risk. Essentially, once planning permission is obtained, technically a development can then proceed. However, it is possible for a third party to challenge the process by which the decision was reached. Therefore, it can cause delays in development and ultimately an injunction stopping that development, or in extreme cases, the planning permission can be reversed. An application of a judicial review must be started within 6 weeks from the date of the decision. I say must. This is strictly applied, but the courts do have discretion to extend, and this becomes really important when you're looking to insure this risk, as insurers will offer different periods of cover. So some will only offer cover for the 6 weeks, some will give 6 months, and then there are others that don't actually have a time limit within their wording. So it is crucial that you're advised properly on the different, because on the face of it, the policies can all look the same and one premium might look great. But if you were constricted to 6 weeks and the courts have got discretion to extend, you could still find yourself in a position where you don't have adequate cover. Factors that insurers will consider then: will works begin within the judicial review period? This will need to be factored into the limit of indemnity that you require. Obviously, if no works are planned to be carried out within that period, then you can look at sort of choosing a lower limit. They'll want to know if the property is within a conservation area, if it's listed, any adverse publicity, any objections to the planning, sort of referencing JR or anything similar. And there have been, again, I'll mention this later, but one of our insurers that we deal with have had a number of large JR claims in the last 2 years, but this hasn't sort of dampened their appetite at all. So cover is widely available for this type of risk. Moving on to rights to light next. Again, this may be one that you sort of come up against sort of more often. And there are a number of factors to consider. So I've tried to put this in a concise manner, but I totally appreciate there may well be questions following this. A right to light can essentially be accrued in a number of ways. Most commonly, this is by prescription. However, again, it is important to engage with a broker on this because definitions within policy wordings differ across the board. So we always look to negotiate wider wordings. For example, I'll always push for the insured use to say a right to light howsoever required, so you're not limited then to prescriptive rights only. Importantly, the right applies to the property and not the owner. So where a right has been automatically acquired through 20 years prescriptive use, that particular owner of the property doesn't need to have owned or lived there for 20 years. They could have just moved in. They are still entitled to make a claim. Another thing to be really aware of is the risk of transferred rights. I've had a number of clients say to me, oh, don't worry about that property, that's fine. It was demolished and rebuilt 3 years ago, so it hasn't acquired any prescriptive rights. This isn't strictly true. If coincidence between the old property windows and the new windows can be proven, then there's a very real risk of transferred rights. So quite often in a scenario like that, we or the insurer will recommend or insist on a further transference study being carried out by the surveyor. Yes, that comes at an additional cost, but in order to truly determine that risk, that would need to be done. It is also very important that all properties assessed within a rights to let report are covered. Insurers can be quite naughty in when they receive a rights to let report, they will look only at those properties deemed as having an actionable injury and will include those within the policy wording. But there may well be 20 other properties assessed within the rights to let report that are deemed as having a minimal injury or a non-actionable injury, but that doesn't preclude them from making a claim. And so you could be in a position where, yes, all the main risks or the main properties with an actionable injury are covered. You or your client could get 20 other properties making a claim that they are on the hook for legal and professional costs, surveyors' costs, which will accrue quickly and amount to a substantial sum of money. So we will always ensure that all properties mentioned and referenced within that report are included within the policy wordings. And I say insurers are naughty because when we do request that the additional properties are included, they don't tend very often to actually increase the premium by doing so because they are low risk properties. So important one to remember on that. There's just another slide on rights to let here. So the case law on rights to let is changing and is likely to continue to change as more cases go through the courts. However, this area is prevalent in seeing lots of negotiations settle out of court, and we're waiting for further ones to be tested. You may well be familiar with the Chelsea Football Stadium case. The site was eventually appropriated by the local authority, which removed injunction risk. Therefore, the claimants on this one, unfortunately, were then only entitled to statutory compensation after months of protracted negotiations, which threatened the entire build. Another common misconception I see from some clients is that they think once the building is fully complete, that the injunction risk is removed, which again is not the case. The case law precedent stands that whereby a fully completed pre-let development was awarded an injunction. I mean, the reality of it is that building still stands, but that would have settled outside of court for a considerable sum of money. But as I say, the precedent is there that a fully built pre-let building was injuncted. So it is critical that the cover is in place for rights to let where there is an issue. There are a number of different strategies when it comes to rights to let cover. So it is really important that you're advised properly on the differences because they do have a big impact on the financial exposure. The main issue, the main reason people want these types of covers so that they've got that certainty of financial exposure. And depending on which strategy rights to let cover is based upon, will depend on whether you've got that or not. Wait and see cover is what it looks like. You pay a premium, you wait, do nothing, say nothing, and if a claim comes in, the insurer steps in and fits the bill for anything over and above. A proactive agreed conduct strategy is where the risk is deemed so high that the insurers will insist on negotiations taking place on a proactive basis. So the policy would be placed on cover and the negotiations would start with that particular property owner. So an excess, a deductible would be in place against that particular property or properties, usually in line with the compensation budgets within the rights to let report. And it's not an all or nothing scenario. So you can have a wait and see policy, but with 20 properties covered, with only one of those properties needing a proactive agreed conduct cover. So it can be like a mix and match depending on the needs of the insurer and the situation. Reactive and wait and see excesses. The main difference here is a wait and see excess is what you'd expect a traditional excess to be. So it could be £100,000 excess. If you have a claim, you pay the first 100,000. Anything over and above, the insurer steps in and covers the cost. With reactive excesses, the legal and professional costs will remain the responsibility of the insured, and this isn't always clear from the wording, or people don't tend to know the differences. So that is something that you really, again, need to be advised on, so that your client is fully aware, or you as lender are fully aware of what those financial exposures are. We've seen an increasing amount of insurers going for the reactive excess option. I tend to push back quite a bit on this, and sometimes we can get them to revert to wait and see. So it's not always what you're offered is what you can end up with. But again, that's where we come in to negotiate on your behalf to do so. So some market trends then, just to finish off. I've spoken a little bit already about pre and post planning. I think a number of years ago, pre-planning cover wasn't as readily available as it is now. Premiums tended to be a lot higher. But now, given how competitive the market has got, it's not disproportionately so. So it's very rare that we're unable to structure cover on a pre-planning basis. I mentioned judicial review claims a little earlier. Again, it's not affected the market. There are still plenty of insurers willing to offer cover on these risks, and premiums tend to be driven down quite low because of that competition. Restrictive covenants. So there are hotspots in the UK. There's certain areas where beneficiaries are known to be prevalent, active in enforcing their rights. Bournemouth and Purley being one, but there are obviously multiple areas, but those are the ones we've come across more often than not. It's not to say that insurers still won't cover those beneficiaries, but it may be subject to a nominal excess or something. But even where we've had scenarios where the majority of the market has declined to quote, we've still managed to structure cover with another insurer. So always ask the question. Listed buildings. The listed buildings officer in Liverpool is known to be particularly prevalent. And this is where sort of knowing the markets that we use becomes important, because there's one particular insurer with a senior underwriter who's from Liverpool, who's very much aware of this particular officer. And so listed buildings cover is something they just absolutely will not touch. But then you've got other insurers who are more than happy to do that. So market knowledge is really important when looking at specific risks like that. Capacity in the market varies between insurers. Generally, they'll offer cover up to 150 million. Anything over and above that we'd need to do by way of excess layers, which again isn't a problem. But if you've got a particular need for all the insurers to be within one insurer, there are insurers that have sort of almost an unlimited capacity. I think the largest one that we've looked at is 500 million. So there are options there. Claims, we do have an in-house claims team, but given the niche area of legal indemnities, we do actually deal with it within the team as well. So you're not sort of, if a claim comes in, you're not farmed off to an outsource or anything. We will deal with that for you alongside the insurers and their legal advisors. With rights to light, I mentioned earlier that the market gets slightly smaller for those particular risks. However, there have been new players entering the market, Dual and Aviva. So again, that where premiums were sky high sort of a few years ago, premiums are coming down now due to that competition within the market. And finally, then I mentioned here no search policies for environmental cover and on a development basis. Insurers don't tend to like these risks so much. So they don't like covering environmental issues where a development is ongoing. But there are literally two markets with specialist divisions within them that will look at these. So these are all things that we can consider for you. Last point then, minimum premiums. There are some insurers out there that have, I think lockdown has given them a bit of time to review their strategies and have started implementing minimum premiums, but generally these aren't a problem. There are enough insurers in the market where we can still obtain an option, options for you and your clients then. There are a few further slides on here with some case studies, which I'm not going to go through. They're all pretty self-explanatory. just adds a bit more context to some of the things I've been talking about. And I just finally want to mention that, as I say, there are around 50 risks within the legal indemnities remit, but there have also been occasions where there hasn't been a product available for a specific risk that we've been asked to cover, but we've worked with, in this example was Zurich, to actually create a product. So it just remains for me to say, if you, your clients, have an issue or come up against something that is threatening a deal, just ask the question and we will do everything we can to see if we can structure a solution. And that's what we like to do, that's what we pride ourselves on. So anything, as I say, that there is a problem, we're happy to look at. And thank you very much. Sorry we've run over. Are we opening up for questions? I don't know if any have come through.
I think we've got, thanks, Sarah. It's probably my fault that we've gone over, but just got 2 questions that have come through. The first one, thanks for this. So, can JCT 651 cover be arranged on project-specific insurances arranged by the borrower, or does it only attach to contractors' insurances? Yes is the answer. It can be on project-specific or on contractors' insurances. I think the thing to say is that it should generally be an extension to the contractor's public liability. But what may happen is that the contractor's liability is covered by the OTIP, by that wider policy that covers the liability for everyone on site. So in that scenario, it generally would tag on to that. There's no reason really that the contractor's public liability can't be extended. It can be arranged by the employer if for whatever reason it can't be arranged by the contractor. But the insurer is a little bit more reluctant because they want to understand why the contractor can't extend their public liability policy. I think that's okay. If you've got any specific question on a project, then same for, as we said earlier on, please send us an email or I'm happy to have a conversation with you. I think then the next one, loss of deposit cover, really quickly. So it's a niche product, I've got to be honest. There's only a limited number of providers that provide this, and usually the conditions within the policy may not actually achieve what the client or the policyholder is looking for it to cover. So I'd be reluctant to recommend it. There's very few that take it out. And I would probably say that it's worth a discussion with the individual client or with whoever asked the question. I'm happy to follow up with you to get to the bottom of what's actually looking to be achieved and whether the insurance policy is actually the proper way forward. I think if there's any more questions, I think we won't keep you too much longer. I think it's probably best if there's any more questions. That was a bit of a whistle-stop tour, so we've done that quite quickly in the time we've got, which might have been quite a lot to comprehend. But if you've got any more questions or anything you want to ask about specific projects or something you're working on for one of your clients, then please pick up the phone. We'll send you an email after this, it might be a short survey in there as well. But thank you for your time and have a good afternoon. Thank you.
Thank you.